Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Well, if you think your investment portfolio had a bad year last year, you're not alone. Saudi Arabia's public investment fund reported a loss of $11 billion last year compared to a profit of $19 billion a year before that. Even though I'll put a disclaimer that if these numbers look big, let me tell you it's against huge asset under management, close to around 600 to $700 billion. So the losses are actually quite small. Coming back to the markets, it's the CPI day, something markets will be following. A stronger print will cement the rate hike probabilities for the next two meetings. While what's strange is that despite weak economic sentiments from Europe, Euro has been rallying. Good morning, JK. You're an excellent person to reach out to in case of such strange readings by the market. Help me decode the current situation in the financial markets.
Good morning. In fact, I think you rightly pointed out that strangely European FX rate has been going up despite weak economic data, and I mean it has been observed that they have been hiking into economic weakness, and that's a very challenging thing going forward. Of course, inflation has not relented in the Europe as it has done in US. So if you look at the European real rates, they are still in very deep negative territory because inflation is much higher than the policy rate. So Europeans traditionally are very inflation or controlling policy. Therefore, they are somewhat sacrificing the growth in favor of controlling inflation. But I think maybe we may be close to a time when they should consider growth also as a priority, because we are seeing a very strong, steady stream of weak data from Europe. Yesterday's June number was one more evidence that, following on with the IFO and Sentix index on Eurozone sentiment, all of them have come weaker. And in the recent past, I cannot remember any strong number from Europe. Apart from the fact that the ECB is likely to hike rates, which is supporting the euro, there is also a sympathetic move along with the yen, which has gained almost 3.5% from the recent low of 145.07. There were talks at 145 that the Bank of Japan might be intervening, but we've actually not seen real intervention. Although I suspect that there could have been some covert action by the Japanese authorities, but fall from 145 to 139.5 to today in Asian time has also rubbed off on other currencies, and thus lifting them. So overall dollar index itself has been down. And the other currency which merits look at is the GBP, which actually is moving towards major technical or psychological level at 1.30. It's come a long way, like 1.03 to 1.30 is a very long journey for the GBP, right from September last year. And strangely, even the yields were at almost the same level in September last, and they are back at the same level. But GBP at that time was at 1.03, and today it is at 1.30 almost. So that's the way FX market operates. And yes, talking about the losses for investors last year, I think it's not surprising at all, because look at the way the bonds have moved. Saudi Arabia is one of the largest countries who invest in US treasuries and also in treasuries all over the world. And having seen the interest rates move from 0.25 to 5% in US, minus 1% to 3.5% in Europe, I think these are very, very big moves. And looking at the portfolios, it's not surprising that they have made such losses. In fact, I also read a report which said that last year Japanese investors were very smart in removing a lot of their treasury investments, looking at the way the inflation was moving and interest rates were moving higher, and they have flowed back that money in this year into the US treasury. So perhaps the Japanese have acted very smartly. Yes, coming back to the markets, the CPI number in US today, headline expected to come closer to 3.1%. A lot of help coming from the base effect advantage, but the month-on-month number is expected to stay at 0.3%. But what may give comfort to Fed is some moderation expected in the core inflation as well. But again, one needs to be careful because these base effect advantage as well as the effect of lower oil prices may be waning. Now that the dollar is softening, we have seen the crude oil prices going up along with cuts in production from Saudi Arabia as well as Russia, and so we will have impact of these things on the CPI in the coming months. So currently we are discounting a number for June. But going forward, the inflation may not be as low as we are seeing right now. So we may be seeing the best picture on the inflation as of now. But market is not, market is currently going by these numbers, and that's why the dollar is down. Yields are down massively. 2-year yield down from 5.12 seen last week to 4.85. And a 10-year is also inched back below 4%. And these are very big moves. On the equity front, help again coming from the lower yields and the fact that some of the Fed members are slightly sounding less hawkish, I would say. Some members even hinting at a possible peak in rates very soon. Like I pointed out yesterday, the fall in wholesale used car prices and also tightening of credit conditions, all these things, though they are second tier data, they all add up as far as the overall economic conditions are concerned. Therefore, these might be giving more support. Yes, the stock markets, of course, have rallied almost 1% in Dow as well as in the global composite index. I think all going by the US yields falling and also expectation of a softer US CPI as well. On India, we have just followed the fortunes of yuan and the yen, and what was looking a nervous market on the INR because of the way we had moved up from 81.75 to 82.80. I mean, there were some people who started talking about upside break, but thanks to, once again, central bank's effort in containing the volatility, as well as the moves in the dollar index down by more than 1%, rupee has stabilized, and we are looking once again at going towards the lower end of the range, at least towards 82 in the coming days. No special domestic factors except the stock markets have been, making steady highs. Steady new highs, and also we have CPI report from India. Yes, there is a bit of a slight negative possibility because the inflation is expected to inch up to 4.58% from 4.25%. We had dropped steadily for the last 4 months, and that is actually now slightly reversing. The food prices, as we all might have experienced ourselves, is contributing a lot to it. Of course, the delayed and unpredictable monsoon has also contributed to the cropping season, and these are some factors which may play out in the coming inflation numbers. So people who are hurrying to call for a rate cut by RBI might just be silenced for now, and RBI should be continuing with their restrictive policy for some time. All the policy rate itself may be on a pause. Thank you.
Thank you, JK. And very interesting that there is a possibility in rise in inflation in India due to the rise in food prices. Especially, I'm sure everyone is following what's happening with the tomato prices because that's been rising. When it comes to the global market, what I found interesting was, of course, the move in GBP. As you rightly mentioned, it's at the psychological level of 1.30. But what's interesting is the GBP, the UK yields are at the same level as the gilt crisis, but GBP at that time was at 1.03 and now closer to 1.30. So that's pretty interesting. CPI headline today, US CPI headline is expected to come at 3.1%, driven by the fall in crude oil prices. But since crude oil prices have started to rise again due to a weak dollar and production cuts, this can again in future trigger some inflation concerns. It seems like it's some sort of a vicious cycle. That's it from us today. Thank you for tuning in and look forward to catching up with you tomorrow with another round of fresh updates. Thank you.